Good morning and welcome to this Monday, May 10th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. We had kind of a disappointing jobs report on Friday. It's been a little while. I guess it's been since Thursday since I've done one of these shows. But non-farm payrolls came in way below expectations, and the prior month, March, was revised lower. So you would think that combined with some pretty good earnings reports might spur on technology on Friday, and it did at the open, but really failed to capitalize on that strength early on. And it's just you can just sense the money continuing to rotate away from technology and to some extent consumer discretionary, many of the growth areas, and into value. And that's something that we continue to deal with. Uh, Something else to consider over the weekend, we saw Ethereum absolutely exploding, up 250 to 4,126. So it has its first close over 4,000. I don't talk too much about cryptocurrencies on here, but Ethereum, its market cap now is only maybe it's about a half of Bitcoin or close to a half. But Ethereum has been outperforming Bitcoin now for quite some time. And that first close over 4,000 I thought was worth mentioning. I'm going to get into everything that happened on Friday in just a minute. But first, for those of you maybe that are new to Earnings Beats, let me just point you to our homepage. If you go to earningsbeats.com, you can sign up. We have a free newsletter. Actually featured an energy stock this morning that had certainly looks, well, I think it looks pretty good to me on the surface. But I had written an article, actually a couple of articles recently, one in Chart Watchers, one in my Trading Places blog, talking a little bit about earnings and the reactions and so forth. And energy has gotten the best response to earnings. Now, I know energy's been really hot here over the past few months. But when you look at it on a long-term chart, we're going to look at all the sectors and look at it on all of them relative to the S&P 500 in just a bit. But it's at least worth noting in the short term that materials and energy continue to be among the leaders, which is important from a trading perspective. I would personally still be careful of the big picture, but can't argue with the short term. I mean, energy and materials both very strong. But anyway, one of those energy stocks mentioned in the Earnings Beats Digest this morning. And if you'd like to begin receiving that, just type in your name, email address, hit the subscribe button. It's free, no credit card, unsubscribe at any time. It is published Mondays, Wednesdays, and Fridays before the market opens. A number of times it's just, can be a good candidate for trading. Also, we try to make those articles very educational in nature, explain a little bit about some of the things that we look at Earnings Beats, which revolves a lot around earnings, relative strength, and those sorts of things. But anyhow, if you go to earningsbeats.com, make sure you sign up there. We'd love to have you as part of our community. We also make a lot of announcements to our community when we're having events and things like that, many of them free. So that would be another reason that you'd want to be part of that. All right, let's move on to the major indices and what happened on Friday. You can see the Dow Jones sets another new record. I remember, talking about the Dow when it went through 31,000. I said, well, it's probably not going to be long before we go through 32, 33, 34. You could just kind of sense that the Dow Jones, which had been underperforming for a while, was poised to perform well. Whether or not it led, that will remain to be seen, but it definitely looked like it was ready to take off. We've now gone through 31,000, 32,000, 33,000, 34,000 here in the first 4 or 5 months in 2021. And I think we're right around the corner. Maybe today, who knows, we could be at 35,000. And this kind of all fits in to that secular bull market theme that I've continued to discuss. Whether it was during the pandemic, whether it's here in 2020 during the recovery, the reopening. I do believe that we're going to have some scares from time to time. I'm beginning to get more of a sense of that as we go further throughout the summer and into the fall. And one of those scares that I've talked about over the past couple of months. One of them I think is going to hit. It's going to be inflation. And I don't think inflation is going to be a problem. I just think the headline numbers are going to be a problem, and it's going to talk. There's going to be a lot more talk about inflation. We do have the PPI and CPI coming out later this week. CPI on Wednesday, PPI on Thursday. If those numbers come in hotter than expected, it could definitely create some short-term turmoil. And it's also worth noting that we're almost getting to May 15th. And the significance there, if you follow my blog articles, is that I think it's over the last 71 years, April 1st to May 15th. So that's when, you're leading up to earnings, and then most of the earnings come out. From April 1st to May 15th, the annualized return on the S&P 500 is about 14 or 14.5%. Once you get past that May 15th level or date, May 15th to June 30th, that annualized return over those same 71 years drops to about 1.5%. So most of the gains historically, every year can be different. So, this is no guarantee, but I think it's very useful to know the tendencies of the market so that you can lower your expectations. I think that's the key, because as soon as the market doesn't do well, everyone's going to be thinking, oh my gosh, here we go, bear market. Bear market's coming, inflation, and you're going to hear it all because you always do. Interest rates, inflation, blah, blah, blah. Stock market's going higher. But short term, you're going to get scares. And I just want to point that out. Wednesday, Thursday, keep that on your calendar, because it's, almost tying into the middle of this calendar quarter. And we do tend to see weakness. So just kind of keep all that in mind. And again, I think the key is just to set your bar, your expectations just a bit lower as we move out of earnings season and start moving into, a time when we don't have as much news and we don't have as much news to anticipate. That's when the market tends to go through these periods of rotation and selling. Anyhow, Dow Jones, you can see strong day on Friday. S&P 500 up 31, 0.75%, setting a new high, all-time high at 42.32. NASDAQ, as I mentioned, technology got a nice start on Friday. A lot of earnings came out Thursday evening, many of them just awesome in the tech space. But the market doesn't care right now about tech. And, you go through periods of rotation. And right now we're definitely in one of those. When we go through the sectors in a bit, you'll see it more on the relative chart than you do on this chart. Because actually, when you're looking at an absolute chart and you're just looking at technology, it's going up. I mean, we're putting in newer, higher highs, higher lows, but the relative strength has really tailed off. And certain areas of technology, especially software and some of the semiconductor stocks recently, not reacting well at all to their earnings. Another one this morning, which I'll go over in just a bit. But anyway, NASDAQ we'll talk about, but technology just really just can't get out of its own way right now. Mid caps, another big day on Friday, up near that all-time high. Small caps strengthened, broke out to about a 2-month high, maybe 7-week high, but really good action there. AD lines across the board strong. I mean, we have seen the AD line in the NASDAQ pull back a little bit, but prices pulled back, so it's not really that big a deal. But as we move up, you can see the other 4 major indices all setting new highs. The market's being accumulated. This is not, some kind of a false move to the upside. To me, it's just the rotation. That's the key, and that's what I've been talking about really for the last 3 to 6 months, ever since the positive vaccine news came out. It's like, okay, the market's going higher, but what's going to lead? And that's been the real issue here over the past 3 months, especially. Energy, real estate, industrials, materials, discretionary. There are your 5 big winners from Friday. I think consumer staples was flat, and the other 10 sectors were all up on Friday. So bull markets are, one of the hallmarks is wide participation. For a while, energy was lagging. Well, that's not the case anymore. You can see energy making the breakout. Energy looked like it was going to open up strong again this morning. We'll know more in just a little bit. But energy, you can see real estate bouncing off the 20-day. Industrial's just been straight up. Materials, same thing. Discretionary, like technology, has been struggling recently. But it's all about perspective. It's all about big picture. discretionary and technology have led by a wide margin throughout the entire secular bull market that began, in my opinion, it began back in April of 2013. That's when we cleared the 2007 high and the 2000 high. Now, some with perfect hindsight go back and say, hey, March 2009 is where it started. But at the time, you didn't know it was starting there. You didn't know if you're going to go sideways for a while, maybe go back down again. Even through 2010, 2011, we were getting those moves to the upside. We had big swings back down. Anyway, for me, it was all about 2013. That's when the bull market was confirmed. And from that point forward, secular bull markets tend to last close to 20 years. So we're in 2021. You take 20 years from 2013, that's 2033. Now, I'm not saying the market's going to keep going up like it's going up right now until 2033. That would be crazy. But I do think we're in a long-term bull market, and we're going to have short-term secular bear markets from time to time, just like we saw with the pandemic, just like we saw with the trade war back in the fourth quarter of 2018. But the overall long-term, in my opinion, is higher for quite a while. I've thrown out some numbers. I know, people think I'm nuts, but S&P 500, I see minimum 10,000 in 10 years. I think probably 15,000. And we're sitting at 4,200. Now, a lot of folks didn't think we'd see 4,200 when I was saying 4,000. I mean, if we hadn't had the pandemic, we would have been there at the end of last year, which was what I had discussed in the Market Vision 2020 conference that we did back at the beginning of 2020 in January of 2020. So that was a pretty bold prediction. I thought we were going to 4,000, and we had the pandemic, and we still almost got to 4,000. But anyway, S&P 500, I see it going a lot higher. So we've got really good action. I'm going to get into the individual sectors here in just a minute. I do want to just go through quickly the 10-year Treasury yield, get an update there. Don't really have anything in terms of economic news coming out today. You can see here this huge move that we had back on Friday. So the 10-year Treasury yield, we saw money pouring into Treasuries with the yield dropping precipitously early on Friday when that jobs report came out because it was so weak. So lower interest rates, the weaker jobs, that you would think would have set up nicely for technology. It honestly didn't. The technology group gapped up and then really struggled from that point forward. So I think 10-year Treasury yield just continues to consolidate. We got that negative divergence. We've talked about that many times. Came back down. We've now reset this PPO on the 10-year Treasury yield back at 0. I think we've got really good support down around 150. I think our resistance is about 175. I think we consolidate there before ultimately breaking out to the upside. And if these reports on Wednesday and Thursday, when we get the CPI and then the PPI, if those reports are inflationary, you can expect the 10-year Treasury yield to move back up. Normally, the 10-year Treasury yield moves up and the S&P 500 moves up with it. And the reason is pretty simple. When the yield goes up, money is coming out of the Treasury market. That's what causes the yield to go up. It's selling of Treasuries. Well, when you have selling of Treasuries, normally the reason you get out of Treasuries is because you see the economy picking up and heating up, and you want to be in stocks because when the economy is strengthening, stocks generate more profits. They expand their multiples, and you're in a bull market. So if you look back historically, the 10-year Treasury yield and the S&P 500 have a pretty solid positive correlation with one another. So if we move back up in the 10-year Treasury yield, what you would expect is for the S&P 500 to move higher. Now, there's one exception to that, and that is if interest rates are moving up because of inflationary reasons, because inflation eats into the profits of corporations. Inflation is a bad thing for stocks. So if we get into a real inflationary environment, yeah, I would expect the stock market to pull back, maybe even considerably. I don't think that we have an inflation problem, though. I think we're going to see some headline numbers that are going to have a lot of folks coming out talking about it and writing about it and having shows about it and everything else, but I don't think it's going to be a problem. I think what's going on right now, quite honestly, is everything in the market is catching up. And what I mean by that is throughout this pandemic, things shut down. I mean, we went through a period where we weren't doing anything. We were literally shut down. The country shut down for a month. And we've had so many companies that have been, working from home or just literally had to shut down for a period of time or substantially reduce the amount of business that they were doing. And now all of a sudden, what's happening is we're reopening and we've got this, imagine like a water hose, when you kind of tie it in a knot and you kind of hear it, it like wants to explode, but it can't, because it's tied in a knot, it can't, come out. And then when you finally, take it out of that knot, the water just kind of shoots out. That's kind of what I think is happening with the economy right now. We went through a period, a lot of the supply chains were cut off or significantly altered and reduced. And now all of a sudden, we've got everybody wanting to do all of these things. We want to build houses. We want to, get out and socialize more, maybe go to restaurants, go on vacations, whatever. And all of a sudden, there's this huge rush. Somebody's untied the knot in our economy, and everybody wants to get out and do these things. So demand is crushing supply at a time when the supply chain had been disrupted. And so there wasn't as much supply in some of these areas, and all of a sudden we've got intense demand. And so, of course, supply and demand, that's going to drive prices higher. I mean, almost anything you look at right now, prices are going through the roof. But what's going to happen is that demand is going to slow down at some point. Supply is going to pick up. And then once we get to that point, I think things will level back off again. But in the short term, I believe we're going to see some inflationary numbers that are probably going to spook people. And I think that combined with interest rates are the two things that are going to create these opportunities over the next 3 to 6 months. And I don't know if we're going to see a sell off this week with inflation, or maybe it's next month, but I do think inflation will be the talk for the next few months. And that is going to be something the market's going to have to deal with. And it'll be very interesting. But one thing I would watch is the 10-year Treasury yield and the S&P 500. Do they begin to diverge? If the yields go up as a result of inflationary pressures, then you'll probably see stocks sell off. If stocks keep going up, to me, that's an indication that the market doesn't care at all about inflation. So something to look at, just consider. All right, let's go in and take a look at some of these sectors. So what I'm going to do first is just start off from a big picture. I mean, when you look at technology and you look at the relative strength, now 2013 right here is when we broke out, in my opinion. I think it was April 10th is when the S&P 500 finally closed above the the October 2007 high and the 2000 high. April 10th, 2013 cleared that. And so right about that time is when we started seeing technology outperform. And if you look, it's been a tremendous run. Technology is where you generally want to be during a secular bull market. Now, because of the pandemic, I think a lot of that, we were already in a strong move to the upside in the technology area before the pandemic. But after the pandemic hit, we had this huge move to the upside. I think just like everything else is playing catch up, I think technology went too far, and now we're playing catch up the other way. How far this relative strength line goes down, I don't know, but what I can tell you is that we are now sitting at about an 8-9 month relative low on technology. And so if you're looking at technology stocks and you're wondering what's going on, in my opinion, it's not that these technology stocks are bad. It's that the market is completely rotating out of the group. So it doesn't matter what kind of numbers you come up with. And I don't know if you saw Trade Desk's numbers this morning. I mean, I didn't see the revenues, so maybe they missed on revenues, or maybe they warned, but I saw their bottom line, $1.41. Market was expecting 82 cents. That's a 75% beat on earnings. Stock's down 12% in pre-market. Last time I looked, 12%. And we're seeing a lot of this in many of these companies. It's not that Trade Desk is a bad stock or a bad company. They're being revalued. The market is completely revaluing technology shares right now and rotating out. In my opinion, they'll be back. Whether it's going to be next week or whether it's going to be in the fall, that we need to continue to watch relative strength. Right now, the XLK you can see is moving lower, and it, like I said, it's reached about an 8-9 month low on a relative basis. So we need to see that turn back around. Until it does, probably want to, I'm not going to say steer clear of technology, but I would say maybe underweight until the dust begins to settle and we start to turn higher. When it does finally start to move up, there'll be plenty of opportunities in technology, but that is not where the opportunities are right now. Looking long term, again, this is a 10-year weekly chart, consumer discretionary. And also, one other thing I'll mention about that technology, because I just saw it on the discretionary, but as we kept going higher and higher, that weekly PPO keeps going lower and lower. So from a longer term momentum perspective, we're dealing with a negative divergence, which probably will take some more time to work out. You see the same thing with consumer discretionary. Now, we're going higher in consumer discretionary. We've been trying to go higher in technology, not exactly doing it lately. But when you look at the relative strength, yes, you've got consumer discretionary putting in a higher absolute price, but it's a lower relative price. So when I look at this, the thing that comes to mind is, okay, the bull market is carrying consumer discretionary to the upside rather than consumer discretionary leading the bull market. It's the bull market's out there. Most stocks are going higher, and as a result, many of the consumer discretionary areas are still going higher, but several are not. And that's the problem with the overall group. That's why we're seeing that relative weakness. Communication services continuing to go higher. I think this one still looks pretty good. Relative strength is still okay. Volume trends look good. Doesn't seem to be as in the same danger as some of the technology and consumer discretionary names. Industrials on fire. Now, getting back to that comment that I made, catching up. We see technology and consumer discretionary moving lower on a relative basis. Look at what had happened to industrial since the beginning of 2018. What happened then? Trade war. We had the trade war, then we had the pandemic. And so industrials took a major hit to the downside on a relative basis. Yes, we've been very strong on a relative basis and continue to be, but we're still catching up to where we were in 2019. At the end of 2019, we're about where we were then on a relative basis. So I know, when you're in the heat of battle and you're trading and you see the industrials doing so well, you get this thought that, hey, they're just crushing technology. Well, they are in the short term. But when you look long term at relative strength, we still got room to go here on industrials. Whereas technology on a relative basis, you can see has been doing extremely well over the past several years, even though it's much more challenging in the near term. So once again, taking a step back and looking at these long-term charts provides us perspective that you don't get by looking at an hourly chart or even a daily chart sometimes. Financials also breaking out. Financials seem to be on a roll and can do no wrong, but on a relative basis, again, it's catch up. We had a great economy, in my opinion, going into 2020, and then the pandemic hit. And so, yeah, the pandemic, took a lot of things down, but it was a healthcare crisis. It was not a financial crisis. It was obviously a financial pain for a little while, but it was not a financial crisis. It wasn't going to bring down the financial system. So all of these groups that were hit so hard are coming back, and they probably, to be honest, have more room to the upside. I think financials go higher because I think the 10-year Treasury yield is going to go higher, and that will help these financial stocks. But again, a lot of this is just catch up with what we've seen. Consumer staples, defensive group. All right, we're going up. Secular bull market, rising tide lifts all boats. Consumer staples doing very well on an absolute basis. On a relative basis, we're at a 10-year low. In a secular bull market, you really don't want to be overweighted, generally speaking, the defensive areas. Defensive areas tend to underperform during a secular bull market. And so that's what we're seeing here with consumer staples. Healthcare. Healthcare had topped. We got a lot of help from biotechs and I think medical equipment back at the beginning of the pandemic. And so you can see that relative strength jump. But since then, this, for the most part, healthcare is viewed defensively. And we're back now at about a 6-7 year relative low on healthcare. Real estate. Real estate just broke out. Real estate looking really good, right? Well, at the beginning of the year, we were at a 10-year relative low. We've started to strengthen a little bit this year, possibly. And, this is an area that might do pretty well if inflation becomes a concern. You might see even better relative strength in real estate. But for now, I still think the longer term, the big picture here tells me we really, for the most part, want to avoid real estate and utilities. Utilities, sometimes we get breakouts and we're on the verge of breaking out and all, in the short term, someone says, well, yeah, utilities, money is rotating toward utilities. We saw some of this back in March when technology took its big hit and we had some of the defensive groups leading for a while. I saw some articles where people were like, hey, jump into, some of these defensive areas, defensive markets, or defensive sectors are going to lead. They don't lead bull markets. And you can see utilities rolling back over again. Here was that leadership in March. Now it's rolling right back over again. You want to avoid being in utilities and defensive groups when we're in a secular bull market. You'll get pops from time to time when the market weakens, but overall, you really want to avoid defensive areas. All right, so now we get into materials and energy, and this is where it's interesting for me because I think the long term is influenced considerably by the dollar. And materials, as you can see, were down significantly back in March. They came roaring back. We're breaking the new highs. On a relative basis, we have made up more than what we lost from 2019. We got hit in the first quarter and came roaring back. But the long-term trend in materials and energy has been down. We're going to have a really important relative top, I believe, at that 2018 high. We're getting there. We're not quite there yet, so I think we got more room. But to me, the way that the materials are going to react going forward is going to depend mightily on what the dollar does, the US dollar. Since 2011, the dollar has been rising. Now, the last year, it's been, it had rolled over and it's been weak again, but the longer term has still been up for the dollar. And that has created relative weakness in materials throughout the last decade. As the dollar has weakened, we have seen materials come back, but that the dollar, the US dollar index, I would watch right around $89 or $90. I think that was the level that you want to keep an eye on. As long as we stay above that, I'm still believing that the dollar is going to rebound later in the year. And my signals looking at yields in the US versus Germany tell me that that's likely to be the case, that the dollar is going to go up later this year. If that happens, that will send commodity prices down and it'll also hurt materials on a relative basis. So I think that's coming down the road. But right now, materials are leading. Stick with them as long as they're leading. Just be aware of that longer term trend, the big picture. And then the last one is energy. Energy is coming back up, but you can see this has really been a poor group for a while. So we're getting that, here was that big drop, the pandemic, and now we're getting that recovery. It's catch up. And that, to me, 2021 is almost all about catch up. We're coming out of the pandemic. The vaccinations are starting to kick in. More and more things are reopening. And so the demand, that demand, that hose that's been squeezed and put in a knot is now opening up and folks are getting out and they're spending money. And as a result, we're seeing prices in a lot of areas shooting higher, including oil prices. So we're getting this push to the upside. Now, do I think crude oil is going to continue going up from $65 a barrel to $100 a barrel? I personally don't think so. I think maybe we get to 75-ish. So maybe we still have a little bit of room on energy. I mean, we could get back up to this, where we started 2020 on a relative basis. So I think energy's got room here. And I wouldn't be at all, I wouldn't be shy about having energy positions. But keep the long-term picture in mind. Just remember the big picture. All right, let's move on to earnings. So I mentioned, well, let's look at Marriott first. Marriott posted 10 cents versus 3 cents. Market just opened. So let's get a quick update here. In fact, we'll just do 3 earnings reports as our 3 you must see, and then we'll wrap this thing up. So Marriott has opened lower. Its AD line is breaking to a new high, which is a positive. You've got hotels which have been sideways consolidating for a while, which means their relative strength has been diminishing. Watch for a breakout here. A move through 2,600, I think, would be bullish and would certainly help a stock like Marriott. Now, I think you've got really good support between 135 and 140 on Marriott, with obviously your first initial resistance up closer to 160. I think Marriott goes higher because I think the hotels will break out later this year. And I think Marriott, even if it just goes long for the ride, will break out. If it turns into a leader, and that's something to watch. I would be watching this Marriott versus hotels. You can see it's been up and down, mostly just neutral most of the year. But Marriott did report nice earnings relative to what was expected. The second one I'm going to show you, this is Trade Desk, TTD. It's now down 17%, breaking down below these lows. And as I mentioned, if you tuned in late, their earnings per share were expected to come in at 82 cents. They came in at $1.41. I mean, if you're holding this stock, you were at $760 2 weeks ago, and now it's $544 after reporting blowout numbers. Now, I will caution, I have not looked at their revenues. I don't know if they beat on their top line. I'm guessing they probably did, but maybe they've talked about slower growth ahead, because that can be bad, or that is bad for any growth-oriented companies. But still, when you look at the numbers, earnings per share beating by 75% what was expected, and the stock down 17%, you just kind of scratch your head. But this is the kind of reaction that we're seeing in technology. Maybe not quite to this extent, but technology stocks are selling off after earnings reports. And that has been a theme throughout this earnings season. Technology is the worst sector in terms of selling off after earnings. That's not my opinion. That's fact. We've got a spreadsheet now with over 1,600 companies. I've got it broken down by sectors. I've got it broken down by industry groups. And technology is the worst sector. The best, energy. Energy after earnings, we're seeing more and more accumulation, not as opposed to selling, we're seeing buying. Even bad reports, missing earnings estimates, we're still seeing many of those companies being bid higher. So that just tells you where the market's focused. All right, last one I have for you. This is one that was up earlier. So let me see what's going on here. VTRS, they reported 92 cents versus 79 cents. Nice little rally here, but this is a stock that's been beaten up pretty badly. It's a pharma. So if you look down here at the pharmas have been underperforming the S&P 500 for quite a while. We're starting to see it turn back up again. And if inflation's a problem, you might see more and more money rotating toward healthcare. So that could be an area that benefits if some of the inflationary numbers this week come out higher than expected, and you start seeing selling in some of the areas, some of the growth areas, more selling. You might see some of it moving into healthcare. All right, that's it for me. Let me go ahead and just pull up a quick market update for you. We're now open about 5 minutes. Dow up 145 points, getting close to 35,000. NASDAQ down 128. That divergence, that rotation continues. I tell you, it's been horrible for us on our portfolios this quarter. We do have a sneak preview of our next draft That'll be this afternoon at 4:30. Got a lot of interesting things to talk about. Despite a rough quarter that we've had, our inception to date returns have been spectacular. And even this quarter, as bad as it's been, our income portfolio has doubled the S&P 500. So we do have one portfolio that was not heavily invested in growth stocks. And so that certainly benefited the income portfolio. But anyway, I think it'll be a great session later today. Hopefully you can make it. We'll be talking about some of the things, some of the sector stuff that we just talked about here. Also, I'll be talking more about that earnings spreadsheet to give you some insight as to how Wall Street's reacting over these past couple of months. And I think that gives us a little clue maybe as to what we might see as we go forward. All right, everybody have a great day. I'll be back tomorrow over at Stock Charts TV for your next Trading Places Live. Have a great day, everybody. Happy trading.